What's up guys, Jake here. In this video, let's talk about Facebook because Mark Zuckerberg has not been having a good 2 weeks, and I want to explain an option position that I'm currently in that's not doing very well. But first, let's consider the 3 factors that can move a stock price. The first one is quantitative analysis, financial disclosures, quarterly earnings statements. The raw numbers behind a company can definitely move it, which is why in general when I trade options I avoid earnings season. I just don't know what the company is going to say. It's basically a coin flip whether the stock could shoot up or crash down, so I avoid factors such as that. That currently isn't what's happening with Facebook the last 2 weeks. The second factor is technical analysis. In general, the trend is your friend. 99.9% of all trades are done by algorithms and computers, basically fighting with each other, trying to game the system in order to make a profit. So when Facebook's in a clear uptrend, good enough for me, I want to take advantage of this trend in order to make money from options. However, the third factor is qualitative analysis, newsworthy events that can drive the stock price in the short term. And that is what has killed all of Facebook's momentum the last 2 weeks. So let's quick cover the newsworthy events and then I'll explain my options position. The first one is the lingering antitrust lawsuits from the government when Facebook purchased Instagram and WhatsApp. Were they being anti-competitive? Were they basically just trying to buy out and then kill their competitors? Yeah, it seems pretty obvious to me. However, when they did this, the government approved the purchase. So the fact the government's trying to take it back now, I just don't see what that's going to do. In general, though, if the government were to force Facebook to break up Instagram and WhatsApp, that actually would cause Facebook's share price in the short term to go up. Because when companies spin off, in general, the value of the two companies divided is greater than the two companies combined. It's a little counterintuitive, but I don't really worry about this, but it is bad news continuously that Facebook cannot shake these antitrust lawsuits. The second newsworthy event was this massive outage on Monday. This was really weird. I was at work on base trying to check my Facebook, trying to check my Instagram. Couldn't get on for like 5 or 6 hours. So what happened here? Why was Facebook so vulnerable to this? You know, how can all 3 of their major platforms, Oculus was probably down too, but how can all 3 of their major platforms go down simultaneously? There should be some division there, so that can't happen. So Facebook's got to address that problem. But the biggest news story is this whistleblower, this ex-Facebook employee who's come forward. I watched the clips on YouTube of the 60 Minutes interview, and she's very smart, and she's very convincing, and in my gut, I just feel it too. When I go on Facebook, yeah, the algorithm shows me baby pictures, it tries to show me cute animal vids, but the rest of it is just people fighting, people arguing about social issues and conspiracy theories, and in general, Facebook's not fun. It's not where young people want to be. Young people are going to Snapchat and TikTok, which doesn't have this news bias, basically, where the most extreme, outraging content is what gets pushed because it drives traffic on the site. I 100% believe Facebook puts profit before the mental or emotional well-being of their users because they don't think it's their responsibility. And there's a good argument to be made that people are their own curators, basically, of the content they consume. So we'll see where this goes. Probably nothing will come of it. So here is my Schwab account. It's been a while since I've shown you guys this specific account, and it's going to look a little confusing to you if you're not familiar with advanced options trading strategies. So first, let's cover the -5 contracts here and the -5. This means that I've sold puts on Facebook for October 15th with a strike of 340 and October 22nd with a strike of 370. So what was I doing here? First, let's consider that I've sold 10 puts on Facebook that are all currently in the money. They are going to be exercised if Facebook's share price cannot recover. So that's 185,000, 170,000. I'm on the hook right now for purchasing $355,000 worth of Facebook stock. I do not have $355,000 in my Schwab account. So let me do the reveal here. I'm selling credit spreads. I'm trying to take advantage of stocks in an uptrend or a downtrend to sell out of the money credit spreads that have a very high success rate in order to make a little bit of profit. You can check out my complete options trading playlist if you want to learn more about these in detail. I'll quick give you the recap, but so you see the -5 and -5, which currently has me down $17,126. But I've also purchased 10 put contracts on Facebook. So this is a +5 and +5 that are also in the money and will be exercised by expiration if Facebook's share price doesn't recover. And on those 10 contracts, I'm up 14,348. So I'm net down only 2,778. And with credit spreads, these are defined risk-defined benefit strategies for trading options, meaning I've already hit my max loss on both of these credit spreads. And the most I ever could have gained was the premium I was paid right away when I sold the spread. The purpose of a credit spread is to basically not have to put up the collateral for a cash secured put or a covered call. I don't want to ever purchase 100 shares of the stock, and I don't want to own 100 shares of the stock in order to sell a covered call. So when you sell a credit spread, you're selling an option to collect a premium, but you're having to buy another option for less premium at a further out strike. If it's the call side, you buy one with a higher strike. On the put side, you buy one with a lower strike. And it's always the same expiration for that spread. And with Facebook, I was selling bull put spreads. I was bullish in that I thought Facebook would continue going up to $400 a share. And this was on the put side where I sold a put and then I bought a lower strike put with the same expiration. So let me visually show you exactly how this works. The trend was up for Facebook, so I said, okay, I want to sell a put, but I don't want this to be a cash secured put. I don't ever want to buy 100 shares of the stock. However, by selling a put, there's extreme downside risk. Your broker doesn't let you sell naked puts. I could probably afford to sell one put, but I can't afford to sell 5. So by selling naked puts, there's tremendous risk. So your broker requires you to buy a put at a lower strike. So if I'm completely wrong on this trade, like I was with Facebook, news broke, bad publicity, the share price is tanking. So as the share price goes down, the put that I sold is now in the money. It's losing me value. But when it blows past the put that I bought, it's now gaining me back value. So when the share price goes below this line, I can't lose any more money. My risk was capped by the one that I'm buying, because once intrinsic value is determined at expiration, however much I'm losing from the put that I sold, I'm now gaining back by the put that I bought. So I'll show you the raw numbers here in a second. But how do I make money? I make money if Facebook had just traded sideways, gone slightly up, gone dramatically up, or had stayed above my break-even price, which is the strike for the put that I sold minus the net credit that I received for the spread. Obviously, I was way wrong on this trade, and everything is completely gone off the rails. So let me map out for you exactly what happened. Facebook was uptrending somewhere around here. I probably sold my first leg with a strike of 370. I chose a delta value probably about 30%, saying there was only a 30% chance that I was going to be wrong on this trade. And you can't sell naked puts, so I also had to buy with a strike of 365. So when I sold the 5 for a strike of 370, I received a payment of $4,546. I sold those contracts, I got paid. Now you can't sell naked puts, so I had to buy 5 at the strike of 365, so I had to give back. I had to pay $3,998. So the net credit was the difference between these two was $548. That's the most I could have made on this trade if Facebook had just stayed above 370 or kept trending up to 400 like I thought it was going to do. But what is my max loss? And my max loss is the width of the strikes, so $5 multiplied by the 5 contracts that I bought and sold, multiplied by 100 shares per contract. So that's $2,500. Subtract the $548 that I received in premium. This is the break even basically. So my max loss on this trade, if I hold it until expiration, is $1,952. So Facebook is currently at 372. Do you think by October 15th it's going to get back above 370? I don't. So I actually do need to close this leg because I think it has no chance of recovering in 2 weeks. However, I saw the steep decline over 10% and I said Facebook can't go down any further. So I sold another put credit spread somewhere around here, probably when it snapped back to here, and I said, great, this downtrend is over, the gap is going to fill, it's going to go back up to 380. And no, I sold 5 more puts with a strike of 340, and I had to cover myself by buying 5 puts at a strike of 335. So I received a payment of $2,351. I had to give back to purchase for $1,828. Net credit I received was $523. But what is my max loss if Facebook stays below 335? If it doesn't get back above 340 by my expiration dates, my max loss will be $1,977. So when I factor in where I currently am with these credit spreads, I basically can just look at the market value and subtract these and then subtract these, add them together. I'm only currently down on these 2 credit spreads, $2,778. I've been doing pretty well with some of my other trades like PayPal and Walmart and some others, but I think I need to just cut my losses and say I don't think there's a chance that Facebook is going to stop this downtrend in the short term. There's no way it's getting back to 370 by October 22nd, and with the strike at 340, I actually might try and hold on to this one. I think Facebook could get back above 340 by October 15th, which is in 2 weeks. But that's basically what's been going on with these credit spreads in my Schwab account. This was, in my opinion, an anomaly, an extreme example of how news can completely crash a mega cap. Facebook is a very large company, and the fact that their price to earnings ratio is something ridiculously low. It's like in the low 20s right now. When you compare that to Microsoft or Tesla or Apple or Amazon, Facebook is the cheapest of the mega caps considering how much revenue and sales they're doing. It's crazy. Either way, I'll be watching Facebook's share price over the next month because this could potentially be a buying opportunity once the technicals show that Facebook has bottomed out and it's going to uptrend back to 350, 360, 370, possibly 400. I'm definitely going to try and jump back on it and see if I hope I don't get burned again by the Zuck. We'll see what happens. If you guys enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love explaining things to you guys. Till the next video, take care.